Hello, and thanks for joining us for another of our mini webinar series on emerging trends that are impacting the future performance of businesses. In this particular session, we're going to talk about the emerging trends related to the labor situation that businesses are dealing with. We're going to be thinking about labor shortages, skill gaps, and remote hybrid work impacts on the financial performance of a company. When you're done going through this with us today, you're going to be in a position to develop questions and discussion topics that you can use to better understand a company's performance today and into the future. So first, let's talk about the labor situation that businesses are dealing with. Excuse me. As of July 2021, there were 10.9 million job openings and 8.7 million unemployed. That means that for every job opening, there was 0.8 of a person available to fill it. Obviously, that means the labor market is tight. That doesn't even tell us the entire story of what companies are dealing with. If you look at this from a state-by-state basis, you can see that the unemployment rates by state as of July 2021 vary from 9% and higher down to less than 3%. The highest levels of unemployment are in California, Nevada, Illinois, and the East Coast, New York, New Jersey area. New Mexico also has a high level of unemployment. That is not unusual for them, but I think that when you look at where you see businesses being located and where you see unemployment rates, this can really be informative to what you think about businesses' prospects for the future. And this does not address the potential skill gap issue that a company would be encountering on a state-by-state basis and an industry-by-industry basis. So companies have tried to be creative with ways to deal with the labor shortage. I think we all started to hear about the labor shortage in the first quarter of this year. And we started to hear about companies doing things like hiring bonuses or giving away iPads to have people start at entry-level work. We've seen stay bonuses that are not one time or two time, but are every month or every quarter. We've seen increased hourly rates, reduced employee contribution to benefits. We've seen employers offer increased benefits such as educational benefits. We've also seen higher hourly bonus rates when you're looking at the less desirable shifts or days of the week or locations. Employee referral bonuses have continued and become more generous. And then companies are struggling with ways to provide employees with options that make the company more attractive as an employer. And some of those options are remote work options or hybrid work options. But all of these changes, they don't sound like a significant change when you talk about each one separately. But it's really important that we look at some examples of the material impact the cost structure changes can have on a business's performance. Labor costs are typically a significant portion of a company's cost structure. So even a minor change to the hourly rates and benefit structures can have a material impact on the financial performance of that company. And with the current labor environment, it is you're hard pressed to find a company that hasn't been forced to increase their cost structure. So let's look at a company that has been operating profitably and is thinking about making some changes to its labor costs. So This company has 258 hourly employees with an average hourly rate of $14 an hour, and they're thinking about doing a 10% increase in labor costs to allow the company to achieve that magical $15 average hourly rate that we see in the news all the time. So for this company, that's roughly a 10% increase in labor and benefits, takes them from $14 an hour to $15.40. Now, again, doesn't sound like a big change, but for this company, it's $750,000. A 15% labor and benefits increase is $1,125,000, and a 30% labor and benefits increase is $3,225,000. And you might think, well, nobody's going to do a 30% labor increase. We don't need to worry about that. But what I will tell you is that let's just look at a couple examples and see how quickly we get to that 30%. So let's consider a benefit such as a tuition reimbursement program. And oftentimes these are around that $5,250 level. If you give that type of reimbursement program, that's going to increase the hourly rate for an individual by $2.52. For a $14 average hourly rate, that's an 18% increase. Now let's think about an average family health insurance premium of $1,500 per month. And let's change that from 80-20 to 100-0 so that the employer is increasing what they're going to pay. This is a $3,600 a year increase in what the employer pays. It's $1.73 an hour. And for that $14 average hourly rate employee, that's a 12% labor cost. So these two relatively minor, seemingly minor changes, a tuition reimbursement program and changing healthcare structure, could increase labor costs by 30%. And here I'm showing you the math so that you can understand what I went through when I came up with these numbers, and it also help you if you're thinking about doing some of these additional benefits, that you can quantify the impact on financial performance. So let's look at a company, has $50 million of revenue. It's been producing an EBITDA of 3.5 million, and it has a strong fixed charge coverage ratio at 1.32. So a 10% labor and benefits increase, and remember that was that going from $14 an hour to $15.40. So a 10% increase in labor and benefits reduces that fixed charge coverage ratio to just over 1-to-1. A 15% labor and benefits increase reduces fixed charge coverage below 1, and a 30% labor and benefits increase reduces that fixed charge coverage ratio to 0.1. So clearly, the changes that we're talking about on the labor side, ways to respond to the labor shortages and the skill gaps and the changing work environment, are having a material impact on the financial performance of businesses. So let's look at some analytical tools that you can use to evaluate the labor situation that a business is being confronted with. So we're going to talk about ways to evaluate labor costs when you're reviewing historic financial performance. We're going to talk about where you can find the stimulus money on the financial statements, or where you can find the impact of stimulus money on the financial statements, and questions to ask about the labor outlook for a company, and then cost impacts to consider when you're evaluating changing the work environment for the business and its employees. So first on the labor related issues analysis, what we want to do is we want to identify the wages and salaries that are in cost of goods sold, that are in SG&A, and the total wages and salaries. I want to identify the total dollars spent and the percent of revenues spent. And the reason I want to look at each of the categories separately and I want to look at the total is because oftentimes businesses will change where a particular employee class is reported on the income statement. And if you look just at cost of goods sold or just at SG&A, you can miss those kinds of changes. So wages and salaries and cost of goods sold, SG&A, and total wages and salaries, dollars and percent of revenue. Then you also want to identify benefit costs per FTE and as a percent of revenues. So what we do is we determine the number of FTEs at each quarter end, and then we look by quarter at revenues, gross margin, and operating profit per FTE. Now, this analysis from 2019 to 2021 is complicated by the stimulus money. The stimulus money that I am specifically referring to would be the PPP loans and related forgiveness, the employee retention credits, the ERCs, and then grants that were received under different programs such as the EIDL program, Shuttered Venues grants, and the Restaurant Revitalization Grant Program. The reason this is important is many businesses have elected to reduce expenses by the amount of that stimulus money. So for example, a $3 million PPP loan might reduce labor costs during 2020 by $3 million. If you're not aware of that and you're looking at the year-over-year run rates, you'll jump to the wrong conclusion on the financial performance of the company historically and on the future prospects. So it's very important to understand what each company received in terms of stimulus money and where that was reported on the financial statements. And here's a list of some of the programs that the small to medium-sized businesses received in large quantities. So we have the PPP loans, EIDL, B&I CARES Act loans, USDA food purchase programs, the Provider Relief Fund for healthcare, restaurant revitalization funds for restaurants and related types of businesses, the Shuttered Venue Operators Grant Program, and then the employee retention credits. What you want to understand is how much the company received and where it reported or where its financial performance was impacted on the income statement and the balance sheet by these amounts. Another area that you're going to have to think about is the availability of needed labor where the company is located. So you're going to need to, you can't look at this from a national perspective. You're going to need to look at this from the geographic location of where the business is operating. You also want to look at the skill levels that are available and the impact on efficiency. We had one client who was experiencing a 15% reduction in its labor force, but was experiencing a 30% reduction in its output because of the impact on efficiency of reduced skill levels. We're also seeing upward wage pressure overall and more upward wage pressure in certain areas. So you want to understand what the business is seeing in its specific geographic region from a wage pressure perspective. And we're seeing more and more businesses talk about making location changes to improve labor availability and labor rates. If a business is thinking about making that kind of location change, you want to be sure that you understand the disruption that will occur from that and the costs that will occur from that. When we're thinking about the facilities, and this is both from the perspective of moving or closing facilities, but also from the perspective of businesses' footprints changing because of remote work and hybrid work, what we want to understand is the cost structure for each location. We want to understand utilities, rent, and taxes have those clearly identified for 2019 through 2021. And the reason that's important is we need to understand if there were lease and rental deferrals granted, and if so, what's the future run rate for location-related expenses. Sometimes the PPP money was used for those kinds of expenses. If that occurred, you need to understand that. You're going to need to know how the company changed its physical locations during the pandemic, during 2021, and what it expects to do in 2022. And it's very important to identify the cost per location and evaluate per employee costs at each location. You want to do as much analysis upfront as possible when you're making these kinds of changes to a cost structure. So ways to respond to the increased labor costs. The first one is increase the sale price, right? If you're able to increase the sale price, that's a good starting point. I recently saw a survey from the National Federation of Independent Businesses, and it was saying that 44% of the businesses were expecting to raise prices in the next quarter. I'm a little bit surprised it isn't even more than that, because it does seem that the inflationary trends and the labor cost issues are compounding on businesses' performance. So anyway, the first way to offset increased labor cost is increase the sale price. Another method is to reduce the non-labor related costs. Maybe you reduce the number of locations. One thing that we're seeing businesses talk about more than we have previously is increasing automation. Businesses that were looking at automation from the perspective of a 3-year return on investment are now looking at it from a 5 or a 7-year return on investment. And sometimes businesses are saying that they would rather increase their debt service requirements than run the risk of being at the mercy of the labor pool. So I think we're all going to see more emphasis on ways to increase automation. And then there's also the need to analyze the trade-off between hourly rate changes, benefit increases, and overtime dollars. You really need to understand your workforce, and you need to understand the costs of the work, because you're going to need to look at the hourly rate based on increased rates, increased overtime, fewer employees, but increased overtime. So you'll want to play around with the number of employees and the costs and the overtime dollars to make sure that you are matching the skills that you need and the cost structure as best you can. And then also we would look at outsourcing labor or materials to a lower cost producer. And then the last way would be to improve the operating cycle to reduce the need for debt and to therefore reduce the amount of debt service requirements. What can a lender do to respond to this emerging trend? First, you need to understand 2019, 2020, 2021, and future plans for 2022 from a locations perspective and a staffing perspective. And you're going to want to look at performance changes and consider where the stimulus funds were reported on the financial statement so you can better evaluate run rates. And you're going to want to work with the company to consider techniques to respond to these labor cost increases. Evaluate the impact on the cost structure of the business. Evaluate the impact on the loan covenants and the ability to service debt. So when we're thinking about labor issues, what we want to do is prepare a sensitivity analysis of the impact of some of the decisions that we make from a labor cost management perspective. The first thing that I would want to do is evaluate the impact of the lowest hourly rate increasing to $15 an hour, and then all other hourly rates increase proportionately. So I would know the impact on the financial performance of the business if that change was made. Then I'd want to evaluate different benefit changes that might be able to be made to entice employees to come to work, but I'd want to understand those costs. And then I want to understand the impact of increased hourly rates, stay bonuses, other bonus rates on the financial performance of the business. So I look at, what does a $1 per hour change in cost structure mean across the board to financial performance? Once I have that kind of a sensitivity analysis prepared, I'm in a much better position to understand the impact on the lending structure that the decisions that the business is making to attract and retain staff would have on performance. So I will now, once I've done the sensitivity analysis, I'll have a much better idea of the impact on debt service capabilities, loan covenants, and other performance ratios. So with that, I will direct you to additional articles that Focus has on its website, on the Insights page of the website. So if you go to the focusmg.com website and you click on Insights, you'll see a variety of articles that we have on multiple industries, current challenges, emerging trends, best practices. And all of these articles can help you as you're evaluating the financial performance of a business. If you're interested in contacting any of us, on the website you can find all of our contact information, but the contact information is also contained at the end of this deck. If you send an email to any of us, or you send an email to info@focusmg.com, just ask us for the deck that's related to the labor situation today, and we'll be happy to send this deck to you. And with that, thank you for joining today and thinking about the impact of labor shortages on the financial performance of businesses.